Household financial security fell again in December, so we examine the results and discuss the reasons why. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. The latest edition of the DFA Household Finance Security Confidence Index to December 2017 shows another fall, down from 96.1 last month to 95.7 this time, and remains below the neutral measure of 100. The trend continues to drift south as flat incomes, big debt, and now falling home prices all impact. By way of background, these results are derived from our household surveys, averaged across Australia. We have 52,000 households in our sample at any one time. We include detailed questions covering various aspects of a household's financial footprint. The index measures how households are feeling about their financial health. To calculate the index, we ask questions which cover a number of different dimensions. We start by asking households how confident they are feeling about their job security, whether their real income has risen or fallen in the past year, their view of their cost of living over the same period, whether they have increased their loans and other outstanding debts, and that includes credit cards, and whether they are saving more than last year. Finally, we ask about their overall change in net worth over the past 12 months. By net worth, we mean assets less outstanding debts. Analysis of households by their property owning status reveals that property investors are in particular turning sour as flat net rental incomes and rising interest rates hit many at a time when property capital growth is stalling. Owner-occupied households are faring a little better thanks to a range of ultra-cheap mortgage rates on offer at the moment. But they are also concerned about price momentum. Those without property interests remain the least confident as the cost of renting outstrip income growth, and more are slipping into rental stress. Looking across the states, they all slipped a little this time around, with New South Wales now well behind Victoria. We think the Victorian market is about 6 months behind Sydney, so we'll drift lower ahead. Western Australia has not improved this time, suggesting that those talking up the market in the West may be over-optimistic. Across the age groups, young households are the most concerned about their financial position. But every age group shows a small fall this month, perhaps thanks to the Christmas binge, although we think credit card debt will not rise that much this year, and retail statistics may be lower than expected. Looking in detail at the scorecard, which shows the elements that drive the index, job security is pretty stable, but savings are being rated by many to support their finances, while rates on bank deposits continue to drift lower. Households are becoming increasingly uncomfortable with the level of debt they hold, and they should at a ratio of 2 to 1 debt to income. Income continues to fall in real terms, and the costs of living are rising, and childcare costs and rising fuel costs are particularly concerning many at the moment. We also see a slide in net worth as home prices, especially in Sydney, decline, and this despite high stock market prices at the moment. Looking ahead, we cannot see any circuit breakers in the mix at the moment, and so we're expecting the falling trend to continue into autumn. We'll update the results again next month. If you found this useful, do like or post a comment, subscribe to receive future updates, and check back next time. Many thanks for watching.